Hello, everybody. Today we are going to be doing chapter 12. And chapter 12 is a little different from the others in that we're going to step back a little bit into history. Let's just recall what we've done so far. Chapter 5 has talked about future value, present value. Chapter 6, future value, present value of an annuity. And then once we learned the tools, we then applied it in chapter 7 on bonds and in chapter 8 on stocks. So how did we, and how was the application done? Well, we basically said in the case of bonds, let's take a 5-year bond. And let's say you have the following payments expected because the company announced it. And you said, all right, in order to find the price of these bonds, I will take it back and find the present value, and that will become the price of the bond. But for that, I need to know what investors are demanding or what you will demand, and we call that the yield to maturity. And let's say you were going to be happy with the 8% return. We know the price of this bond will be $1,000. Then in chapter 8, we applied it to stocks. And with stocks is different because you don't know what your dividends are going to be, but you can kind of estimate it. And as most firms tend to give it, either keep it steady or at a steady growth rate, you can make an assumption that it will grow at some steady rate. And then let's say your dividend is $2. Then what you can say is price is equal to the next period dividend. And let's just assume you demand a 20% return. Oh, I forgot to put the formula down. The formula is this, 20 minus 10, let's say, so it's 0.10. So 2 divided by 0.10 will be $20. Now, the question here is, how did you get, or how did the market come to say 8% is good for this bond, and R here 20%, which is the demand you demand, or the demand, what is demanded by the market is 20%. So that's where we are headed to. And in particular, what we want to find out, and what we'll come to the conclusion is that the higher the risk of an instrument, then the more you will demand, the more, or rather, let's make it the higher the required return demanded by the investor. So that's you, and that seems pretty logical, right? But we need to come out with a way to quantify it. So the higher the required return demanded by the investor at this point. Now, in this case, we're going to start off with a definition, but do remember that this formula can be rearranged to be written like this. Just simple algebra will do it. So here now we are saying the return is a function of two things, the dividend over price and then the G. And why is that important? Because we're going to go first to the first page and said, listen, first, let's have a clear definition of what we mean by return. When we talk of returns, we essentially, the simplest definition is, of course, how much money did you invest and how much did you earn? And tell me the net amount. How much did you actually part and how much did you actually get in return? And that will give you a total return. So for example, if I invested in something at 100 and I made a net profit of 10, then it's 10 or 10%. But that's like a simple loan. What if you invested in something like a stock? Well, if you invest something like a stock, then we can continue to use our formula that we had derived earlier, which is R is equal to D1 over P0 plus G. How is this? How does it work? Well, let's use a simple example first. Assume you buy a stock today or a share for $37. You keep the stock for 1 year. all right? Then by the end of the year, this is what you do. You sell it for $40.33. In between, you also received a dividend of $1.85. So if the question said, what did you earn? What was your net earning on that? Well, that's simple. You made $3.33 because the stock price went up from 37 to 40. You had a dividend of 185. So that's a total of 518. How much did you part? You parted with 37. So that's a total of 14% return. So if I rewrite that, if I want to break this down, then what I can do is to say 185 out of 37 actually came from dividends. And we call that the dividend yield, or the current yield on this bond. Sorry, not the current yield, the dividend yield. The current yield is the total. The second part is G can be considered as a capital gains. It's what you ended up buying it and selling for, and then dividing it by the buying price. So that will give you 5%. So this 14% is made up of two things, the dividend yield and the capital gains yield. Okay. And remember, the capital gains yield is the price that you sold it at minus PO over PO. So let's do another simple example, just to be clear. If you purchase 40 shares for $25 and later sell it at 35, what is your total return per share if you receive $2 in dividends? Well, 2 over 25, which is 8%, is your dividend yield. 35 minus 25 is $10 over 25 is 40%, so you made a whopping 48%. So if you had invested $1,000, because 40 shares at 25 would be $1,000, you should be getting 1,480 back at the end of the year, because you'll be selling it at 350 of 40 shares, and then you'll receive $2 in dividends. Now, why is that important? So again, I want to be clear. The important thing is to know that you have to define returns very clearly. So if you go here, remember, if grandmother asked you, how do you know you're getting 8%? What will you tell her? You'll say, grandmother, take the 1,000, put it in a bank at 8%, see how much money you get at the end of 5 years. That's over here. Or you buy the bond and put those monies in the bank account, see how much you come here, and they'll both turn out to be safe. So therefore, it has to be 8%. You can do the same thing with the stock. Hold the stock for 3 years, sell it, or put it in a bank. And if you use 20%, then 20% is what you're actually earning. So once we have identified the return, let's see how the return has performed by going back in history. So Ibbotson and Zinkfeld is one of the premier companies that have accumulated data of stocks and bonds over the last, it's going to be nearly 100 years, but right now, they started in 1925-26 for collecting the data. And they compile these returns. What would have happened if you had invested $1 in 1925, and where would you be now? Just take a look at this chart, and we'll start from the bottom. $1 in 1925, if you had just made enough to cover inflation, would have grown to be about $13. If you had put in the safest instrument in the world, with the US government's bills, but 3-month bill, let's say, just short-term bill, which has the lowest interest rate, over this 83 years, you would have made about, sorry, did I get 83? It would be, yeah, 83 years. It'll come to about $20.58. If you had, let's say, put it in 30-year government bonds, it's a long-term bond, so they give you a little bit more higher interest rate. Look at the difference, $109.14. What if you instead put all your money in stocks? Well, if you put all your money in stocks, a dollar would have gone up to be 4,676.88. So just take a look at the difference between these two. A whopping difference, correct? Now you can understand why retirement plans all say when you're younger and you're not retiring, put it in the stock market, because historically we've seen the stock market go just upwards. There are periods, and we've had many of these periods, including recently with the crash of 27, when it stagnates or even falls. But overall, it continues to increase. But take a look at this. Let's say if you invest in small stocks, and remember, small stocks are considered the riskier stocks. So the lowest 20% of the market value of the stock. See the difference. If you can hold on to 83 years, it's practically 5 times more that you make it. So by looking at history, we say, this is interesting. So different instruments have different returns, and some of them are very high and some of them are very slow. In your book, you're also given an annual return. So that's over a period of time. If you annualize it, how does it look? Well, you'll see that inflation was about averaging 3%. US Treasury bills gives a little bit over inflation. Long-term government on an annualized basis is 5.9. 6.3 if you go to corporate bonds. 12.1 if you make large company stocks, and 16.9. Now you say, why is this just a 4% difference when I saw such a huge gap? Well, remember, that's the effect of compounding. Over a period of time, even if it's a small increase, you can do it like that and move it way above. When we talk of risk premium, we basically mean what happens if you invest over the treasury bill, because this is the safest instrument in the world. We call it the risk-free rate. So the short-term government bonds, US government bonds, are usually considered the risk-free rate. So if you had invested in long-term bonds, you would have got an extra 2.4% for taking on a little bit of extra risk, although technically with government bonds, it's not. But if you go to corporate, then it's 2.8% over government bonds. But if you go to stocks, you can be expected to earn an average of 8% above if you're a very risk-averse person and put your money only in government bonds. And finally, a whopping 13.4% more if you go to small company stocks. And remember this, 13.4%, it's annualized over the 83-year period at this point. Okay. All right. Now, the next question is, oops, did I change that? Wow. Great, what did I do? I think I moved it down here somewhere. Hope not. No, I did not. Okay. So, obviously the next question is going to be, yeah, but we know what's the reason. The reason is it's because more riskier, and you're right. So now the question is, in finance, how do we measure risk? Well, it turns out the way we measure risk, and I want to be clear here, is the following. The way we measure risk, let me change it to blue, in finance is based on volatility. And the volatility means how much does this expected return fluctuate over time. So if you invest in some instrument and it has a tendency to fluctuate too high, we consider that as risky, not as risky. You know, it comes to an interesting question. Why is this considered risky? So just assume grandmother comes and you say, you know, I'm going to invest in a stock that I know the maximum goes up to 20, make it 80, 70, 82, 71, 83, 70. That's the most it has fluctuated over the last 2 years. And over here, it has fluctuated 100, 40, 99, 38, 85, 20, et cetera, et cetera. But grandmother could say, you know, I don't understand why you consider it risky, because you also can make a huge amount of money. So sure, you might lose money, but you also make a large amount of money. So why are you considering risky? And I'm going to just give a shortened version of this, and in the simplest answer to do it, but then we can also formalize it, is to say that, grandmother, you are right. Let's say grandmother and you and I agree that there's a 50% chance that the price would go up by 100, and 50% it would come down to 40. Well, let's even dramatize it and make it 0 in this case. All right, not make it 0, make it 20. And in this case, it's 50 and 50, going up and down roughly. That's how it's been fluctuated. Well, we call this, and there's a more precise formula to do it, but I'm just giving you the intuitive one, is to show you that if I'm an investor, yes, sure, I'll be very happy, and I'm going to kind of make it into a story again. I'll be very happy if my investment, let's say I spend $50 on this, goes up to 100, I'll be very happy. But I'll be very unhappy when it comes down to 20. So even let's take it back and make it 0. What we want to show you, or what we are trying to tell you, is that for a risk-averse investor, this happiness measure that goes up with 100 is less than how much you do when you go unhappy. In other words, your unhappiness is going to be way more than what your happiness measure is. Something with this kind of example with 50-50. Most of us are risk averse. Hence, if the increase here is only $10 up and $10 down at this point, or if we invest, let's say, $5 up and down, what we are saying is that because our unhappiness level for an equal probability coming down is more than when it goes up, hence we prefer to have something like this. It's not that we don't want to make money, it's that our unhappiness level of losing is usually greater than the happiness. So most investors are considered risk averse. For an equal probability up and down, we will tend to be more unhappy with it coming down, or rather when we talk of utils or in terms of satisfaction levels. Now there are some people, and you know where they are, in either Las Vegas or Atlantic City, they would actually prefer this outcome. That is, their happiness level is going to be greater when they make the $50, and it's way above their unhappiness level, which is if they lose $50. But that's far and few between. So because of that, most of us prefer to have instruments that are less volatile rather than more volatile. So once you have that, then let's discuss how to measure volatility. And I should have done that before. So we measure volatility, therefore, by fluctuations, and that is done through standard deviation. So in finance, for most part, some measure of standard deviation is used in order to find the volatility of an instrument. Now, I'm not sure if that was done in your QM class, but we have two ways of defining standard deviation. One is a formula where you take R minus R bar squared over N minus 1. And the other is P1 R minus R1 bar squared. How many of you remember what the difference is? The difference is that this one is called the historical standard deviation, which is based on past prices. So you're looking back in the bank. It's like a sample out of a population that you take. You look back, find out what your returns are, subtract it from the mean, and then divide by n-1. So it's a historical standard deviation. This one uses a probability measure, and it's a forward-looking standard deviation. And in the markets, both are used. So in chapter 12, we're going to learn how to do this. In chapter 13, we're going to learn how to do it. It's very straightforward. It's not very difficult. And once you do learn it, you'll find it's very simple. So that's one of the things I want my class to know. Do not get intimidated by formulas. They can always be broken down into simple parts. Okay? So let's try and solve and calculate the standard deviation of a stock. Let's say this is the information I have. Over the last 4 years, I have seen that my stock returned 10%. The year before that is 12. The year before that is 3. And then 4 years ago, it had gone down to -9. What can you tell me about the volatility of the stock as measured by the standard deviation? So let's go and break down this formula now. So the formula says that it's equal to sigma Ri minus R bar squared over n-1. So let's start with the first one. On this, I have R1. It's our stock returns with 10, 12, 3, and -9. So what should I do first in the formula? I should subtract it from R bar. What is R bar? R bar is the mean. So the mean is 10 plus 12 plus 3 is 25 minus 9 is 16 divided by 4. So the mean return is about 4%. So I'll subtract 0.10 minus 4, 12 minus 4, 0.03 minus 4, and 0.09 minus 0.04. And I will get 0.06, 0.08, 0.01, and remember, -9 minus 4 is -13. So let's look at the formula. What does it do next? It squares it. So 0.06 times squared is 0.0036. 0.08 squared is 0.0064. There's actually a squared button in your calculator. 0.01 times 0.01 is 0.001. 0.13 times 0.13 is 0.0169. Let's go back to the formula. What does it do after that? It sums it up. This is the sigma sign, right? So if I sum it up, this is what I get, 0.0270. What's after that? After that, we have to divide it by n-1. So n is 4, so we divide it by 4 minus 1. And then the final step is to take the square root, because if you don't take the square root, you get the variance. So the square root is 0.0947 or 9.5%. So how do we interpret this number? So our mean is 4%. Our standard deviation is 9.5%. So let's go back to QM a little bit. What does that mean? So what it means is, and we have to make some assumptions. Let's say that we say the returns are normally distributed. And actually it's not, it's fat tail. But just assume they're normally distributed. Then what you could tell grandmother is this, that listen, I looked at the past 4 years of data, and if I were to use that, I think on average, I'll probably make a 4% return if I keep holding on to the stock, because it did 10, 12, 13, and -9 to the average of that. Let's say then you want to give it some probability numbers. Well, if it's normally distributed, then what I can do is say, listen, I can give you some estimates. Because I know a normal distribution, if I use a standard norm, I can transform it to a standard normal distribution. And because I found my standard deviation 0.9, if I had 2 standard deviations this way, and 2 standard deviations this way, then I will be able to give you some prediction with, let's say, 95% probability. Now remember, it's actually 1.96%, but we'll use 2. So if 9.5 times 2 means twice the standard deviation is 19%. So what I can say is that with 95% probability, I think your stock can go up to as high as 23%. But at the same time, you could also lose for minus 19%, so roughly about 15% if I take minus 2 standard deviations. So that's the definition, or rather, that's how we can apply the standard deviation of a stock. We say, look, 4%, but I can even do better. I can predict to you how high it can go up or how low it can come down based on the standard deviation that we have obtained at this point. So let me go back to my example. So if I gave you another stock and I said, you know, on average, this other stock, let's say that's IBM, it's 4%, and I can calculate the standard deviation, sorry, the mean is 4%, the standard deviation is about 5%. Then basically what you're saying is, well, if I buy IBM stock, I can expect about 4% return, but 5 times 2 standard deviation is 10. It could go up as high as plus 10, which is 14%, or minus 10, which would be about negative 6%. So a stock with lower volatility gives assurance to an investor that said they'll earn 4%, but it could go up as high as 14, not as high as 23, but then I'll also be protected. It will go probably as low as 6 and not as low as 15%. Now, just to refresh your memory, if grandmother said, no, 95% is not enough, I want 99% confidence levels. Well, then if you do that, then how many standard deviations do we need to go? We need to go 3 standard deviations, plus or minus. So if your IBM stock standard deviation is 5%, then 5%, then multiplied by 3, 15%. So you add plus 15%, minus 15%. So 4 plus 15, then you say, okay, grandmother, it can go up as high as 19, but then it could go down as low as minus 11% instead of this. So if you want to give some confidence of 95% to grandmother, you can tell her, listen, this stock will give you a return of 4. I'd say with 95% confidence, it might go up as high as 14, come down at just 6. But if you want 99%, then I'll say it can go up even as high as 19, but it could go down as low as 11%. So I hope that gives you an understanding of why we use standard deviation and why it can even offer a means to do some prediction on what will happen to the price of an instrument, okay? This is just a review of normal distributions. You don't have to learn the technical side of it. So now that you've understood that volatility is what we use in finance to measure risk, let's go back to the history and see what has happened. Because historically, when we have calculated, and that I haven't shown you, is that we've seen that the volatility of small stocks is greater than the volatility of large stocks is greater than the volatility of corporate bonds. So by looking at history, we've learned 2 things. It's actually just 1, but the book puts it down in 2. The first lesson it says is, if you looked at history, there is a reward for bearing risk. So there is a relationship between risk and return. And the relationship is very clear. The greater the risk, the higher the reward. And if all you have to do is to look at the volatility of the chart of of any chart at any period of time, the higher this return, the higher the risk of any instrument at this point. Okay, so we don't actually give you the full measures of risk, but you'll have to take it for granted that's the case. Now, before I move on, what we learned in this chapter is called, we want to make a distinction between what we call arithmetic return and the geometric return. And the reason is very simple, and it's a very important reason actually. And the reason is that arithmetic return, if you used it to calculate returns over time, might not give you the right returns, okay? What do we mean by that? So let's start with a simple example. Suppose I give you $80 million to invest on my behalf by buying lots of stocks and bonds, etc. Since you've taken 203 and hopefully you've taken other finance classes, you know how to pick stocks, and therefore you do your best job about investing in the stock. And let's say in the first year, you take the stock, your 80 million, and you end up making 100 million out of that. That is, the stock price and all your instruments rise to 100%. So your return is going to be what? Your return, and another way to say it is new minus old over old, is basically you have 100 minus 80 over 80, which is equal to 20 over 80. You can say 0.25, or you can proudly boast that you made 25% return, right? So in this period, you made a whopping 25% return. But let's say the following year, your performance is really bad and it comes right back to $80 again. What's your return for that year? So new minus old, 80 minus 100 over 100 means you lost 20 million. Over 100, that's minus 0.20 or negative 20% return. So in the second year, you lost 20%. Now, can I claim, therefore, that I made 25% in the first year? I made negative 20 in the second year, so that I'm still up by 5% for 2 years. So my average 2-year return, or rather, my average return is plus 5% divided by 4. So on average, I made 2.5% per year. Because I made 25 in the first year, I lost 20 in the second. So combined is I'm still up by plus 5. Divided by 2, it's 2.5% per year. So my question to you is, did I do anything wrong in my calculations? Obviously, you know it's not correct because you're back down to 80. The fact is you didn't do anything wrong. It's just a problem with using arithmetic returns. Arithmetic returns, when it's used over time, can be misleading because the bases change. And in fact, if you ever get a CFA or a mutual fund manager, you'll not be allowed to use arithmetic return. So that's one of the things we want to know. So the solution to that is to use what we call a geometric return. Okay, so a geometric return is defined as follows. It's, instead of arithmetic return, you add, and then you divide it by the number, correct? But in geometric return, you multiply, and then you take the nth root of that. Again, it looks very intimidating, but again, do not be intimidated by formulas because it's very simple when you break it down. So let's go back to our earlier example. In the earlier example, for arithmetic mean, what did we do? We added 10 plus 12 plus 3. Was that 3? Yeah, sorry. 3 minus 9. So 10 plus 12, 22 plus 3 is 25 minus 9, 16. So we said 16 divided by 4 is 4%. In geometric mean, you'll do 1 plus 0.10, 1 plus 0.12, 1 plus 0.3, 1 minus 0.09, multiply it, and then take the root of it. So let me do that because I think some of you are still learning to calculate. So I'm going to do 1.10 times 1.12 times 1.03 times 0.91. Remember, this will be 0.91. Will give me 1.1458. 1548. And then I have to take the nth root, which is 4, but I can also write that as following, same as taking it to the power 1 over 4. So what will I do with this number? When I get 1.548, I'll press the YX button. I'll hit 4, but I don't want to take it to the power 4. I want to take it to the invert of power 4. So I'll do 1 over x and then equal to. So let me do that. Press YX 4 invert equal to, and I get 1.0366. So I get 1.0366. I subtract it from 1.0 and I'll get 0.0366 or 3.66%. Okay. So when I used my arithmetic mean, I got 4%. When I used geometric mean, I got 3.66%. So the rule is that geometric mean will always be lower than arithmetic mean, and there's a reason to that. Now, for your purposes, why is it so important? It's more important when you come to forecasting the future. Because if you use arithmetic mean to forecast the future, you might end up forecasting a little too much and be too optimistic. But if you're using forecast for the short term and you use geometric mean, then you might end up being too pessimistic. So what's the solution to that? So first thing we learned is we do learn there's a difference. The second is it's important comes in when it's forecasting. When the time comes to forecast, therefore, we have a very simple formula which was developed by Bloom that said, listen, here's a simple formula, and that will depend on how far ahead you're forecasting. If you're forecasting into the future, very long, then you will give more weight to geometric mean. If you're going to do it for the short run, then we'll give more weight to the arithmetic mean. Again, looks very intimidating, right? All these numbers, but it's pretty simple again. So let's say we have 25 years of data, and we want to predict, using this returns, what it will be in the future. When I calculated the past 25 using arithmetic mean, I got 12%. It's an extreme example. But when I did geometric mean, it said over the 25 years, the growth was only 9%. Let's say I want to make a forecast 1 year, 5 years, and 10 years. Well, then we just apply the formula where the formula states that this is t minus 1 over m minus 1. So I'm going to forecast in this example for 1. Let me just mark it. This is my t. For the 5-year forecast, I'm going to put this as 5. For the 10-year forecast, I'm going to put 10. The numerator is n minus 1. So 25 minus 1 is 24. And that will be the same for all. Same for all here. And this one is n minus 1. So notice what happens is that when you're doing it for 1 year, this 1, 24 over 24, it becomes 1, this becomes 0. So everything is based on arithmetic mean. But as you go more into the future, this becomes less, this becomes more, and therefore it gives more weight to the geometric mean. So that's all it is. Nothing fancy. That's all it is if you want to use it to predict in the future. And you want to use the Bloom's formula. Now that's as far as we go when it comes to computations. You have to learn how to do the standard deviation using the historical method, and then basically the arithmetic mean and the geometric mean. And then if you may even get a question on the Bloom's formula if you have to do it. Now what we're going to do is just come to a discussion on what we call the efficient markets and market efficiency. And why is that important? Let me show my face for a little bit. Oops. I'm the one still doing docking. It's not a robot. Sounds like a robot, but it's not. So minimize that. Why isn't it minimizing? And the reason we want to do it is going back again to history. What we want to show, and what has been proven wrong, especially in the recent crisis, is that on average, markets are generally efficient. And so if you see the price of a stock today, and if you know that enough analysts are following it, you can basically say that, you know, I can rely on those prices. So a lot of things relies on market efficiency. In recent years, studies have shown that markets are not perfect. There's a lot of herd behavior going on, etc. But I think on average, over long periods of time, we can safely assume that in the US at least, US financial markets are reasonably efficient. But and as you'll find out that our insider trading laws are also based on the notion of market efficiency, okay? So we in finance define market efficiency differently. We don't define it as if it's operationally efficient. That is, if you order a stock, you can get the stock on time, etc. In finance, efficiency is strictly defined in terms of information. How much information has been impounded or used when you price a stock or a bond. So to be more precise, we look at 3 different kinds of information. Let me just see. So we need to understand that whenever you see the price of a stock in a market, you have to assume that enough analysts have followed it, and therefore they've used all the available information is impounded. So let me explain that a little bit more. So what we are saying is, if you say that, look, if there is a stock price that's currently at $20, if I believe that all the analysts have used every information and come to $20, then the only reason the stock should now move and either become 21 or 19 is some new information have come in. So if that's the only reason it should move. So let's say it comes to 20, then it should stay at 20 and then go up or go down because some new information is coming. Now, if we assume that new information can be bad news and sometimes good news, but we don't know, if that's the case, then the new information should be random, right? It should either be good, bad, could be bad, 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 followed by good. So if that's the case, then at any given point in time, the stock price, we call it follows a random walk. We don't know what it will do at this point. On average, it could be anything like that. And if there is no drift, the future value is really going to be $20 at this point. Because if information is truly random, there'll be pluses, minus, and it'll end up being $20 at that point. So statistically, this means that the prices will follow a random walk. All right. So let's now see what the evidence is. So what has been the evidence on the efficient market hypothesis? We do know that they do react to news, because every time, let's say you hear a medical company, for example, got an approval from the FDA, we know the prices have gone up. If a CEO has been fired for alleged improprieties, the prices take a crash. So that we are 100% sure. The only thing we're not sure is, do they adjust promptly? So take a look at this example. Suppose a stock price is around $160 and it's chugging along, and then suddenly there's an announcement. And the announcement is good news. The FDA has approved the price. And let's say I do this for a lot of stocks. And what I notice is this. I notice that the price should actually be 180, but usually after an FDA announcement, the prices shoot way above, and then over a few days comes back and settles down in 80. Now let me ask you, if you saw that all the time the FDA did an announcement, prices usually go up and then comes down, what would you do? You'd probably buy the stock as soon as the FDA announced, and then at some point you say, I think it's going to go back down now, and I'll short sell the stock. So then when you short sell it, you're making money by borrowing the stock, selling it, and buying it later. So boom, I'll make money. Of course, if enough markets do that, what's going to happen? It's going to get shorter and shorter and shorter. Let's say the other way is, and that has happened in many overseas markets for a while, FD announces, and then you notice the prices keep taking a long time to get to be 180. So you go, this is simple. Every time the FD announces, I'm going to jump and buy the stock, because I know eventually it keeps going up for 4 days. So obviously, if all the investors do it, what's going to happen? Going to take place like that, like that, like that. Nobody, everybody's going to buy till it reaches the 80 in equilibrium. So what we say is, in the US, our markets, if they should react instantaneously because the markets are efficient, and therefore when a given information comes in, boom, that should go up, and then we call that markets as being efficient. So by and large, when the information is correct, we notice that the markets do react quickly. There is very little overreaction and underreaction. But what is at question, though, is what kind of information? So let's take an example. We define 3 different kinds of information. One is only historical information. So let's say, and the other is public, and then the other is private, okay? So let's start with the historical, because we say then it's under the title of weak form efficiency. Let's say I look at a historical price of a stock, and let me make it more, I'll dramatize it a little bit more on this. Let's say this is what I notice. This stock over the last few years behaves like that. If you believe this is pretty accurate, what do you think will happen at this point? Obviously, we can expect it to do like that, and continue, correct? Then what you could do is to see, all right, every time the price turns around, I'm going to buy it. And then at some point when it starts falling, I'm going to sell it. So thousands of studies have come where they've used historical data to see if they can predict the price of the stock, and therefore make some money on it. So are there any trading strategies you can use using just historical data? Guess what the results are? The results say, no, you cannot make that information. And you cannot use historical information alone. Hence, we call the markets as weak form efficient. So using historical data alone, you cannot do it. But then you say, that's ridiculous. I know these people are called technical analysis is what's used the word in the market, is very popular. It's used all the time. There are thousands of brokers who use historical data to make prediction, and they're still around there. And our answer to that is yes, on average, technical analysis works. What we are trying to say is consistently it doesn't. There'll always be people who will use certain historical data and be able to make money, but the money disappears because the markets get too efficient, and then you have to come up with a different trading strategy. So what we've proven is that, yes, at a given point in time, you can follow and come out with some prediction in historical data and make money. But the markets are too efficient. Eventually, everyone catches on, and then you have to come up with a different trading strategy. But that's fine. We still consider the markets as weak form efficient because the trading strategies are very limited, and you have to continuously change that. The next definition is based on, this is exactly what I said here. The next form is what we call information that are both historical plus all publicly available information. If we use these, are you able to come up with some trading strategies that are efficient? So, and what other information publicly available? Well, dividend changes, firing of CEOs, approvals by FDA, mergers and acquisition. I mean, there are studies that have even looked at the thickness of annual reports, because there are arguments that the more thicker it is, the less likely the firm is going to do better, etc. Guess what the results have been? Same thing, that you cannot have consistent trading strategies even with all the publicly available information. On average, the returns are zero. We then say the market is semi-strong form efficient. So there's weak form, semi-strong form. Now, we have to be clear, there's some anomalies that are coming out in these studies. For example, well, there was, let's put it this way, there was always the stock of the January effect, which said that if you buy small stocks in January, you can do better because people sell the stocks in December, went up in January, and it held true for 10, 12 years, but then in recent years, it disappeared. Weekend stocks, people usually sell on Fridays, buy it on Mondays, but over time, that has also disappeared. So on average in the US, we say the US markets are semi-strong form efficient. Finally, we have the strong form efficiency. And what we mean by this is historical data, all publicly available data, plus private information. So if you had private information that others did not have, are you able to make money? Now, as you can imagine, the tests are difficult to design because private information is private. How do you test it? But there have been proxies that have been used in order to say and try to, if you had that information, would you have profited on that? And there, the answer is very clear. If you do have private information, you can make money. In other words, the US markets, when it comes to private data, we say it's strong form inefficient. So it's not strong form efficient. And because of these studies is why we have the insider trading laws, because we say that, listen, if you have private information, and the argument is very straightforward, if you have private information, remember, you're a company, there are 100 shareholders, it is not fair that 2 shareholders have some private information and therefore they either sell the stock or buy the stock. Because then what you're doing is the remaining owners, 88 of them or 98 of them, are not getting. and that's not fair. Information should be available because, and that's the job of the SEC, right? They're trying to regulate the market. I mean, there is a counter view that says, hey, let the markets be what they have. If you have people are willing to spend money to get private information, that's their job. But we know in economics that that leads to inoptimal allocation of capital. Because what happens is, if you knew, and the New York Stock Exchange was rife with corruption in the 1920s, and you know, what happens is if you instead of paying a stock price of 80, you'd probably pay 70 or probably pay 60 because you say, I don't know. There's some information that others know that I don't know. So the prices itself will be depressed. So if it's very transparent and there is no insider trading, then the true price of 80 will prevail. So from a social point of view, I think the SEC has a right to say no insider trading at that point. And all these are from studies that have looked at the strong form efficient studies. Okay. Again, folks, that's the end of this class. So once again, it's a very simple, there's very little calculations, a standard deviation, but the idea is to show you that we're headed towards the measurement of risk. We measure risk by standard deviation. Historically, what we've seen is that the riskier the stocks, the higher the returns. But of course, it depends on an accurate measurements of return and risk. And then also, we need to inform you that the markets are efficient on average. And by efficiency, we mean that information on returns are impounded in the price of the stock. And it's only when you have private information that you will find that the stock market is inefficient, formally being strong form inefficient. Okay, so hopefully you're able to do some of the problems that are assigned in the back of the textbook, but we'll also do some in class. Thank you all.